The fragile US-Iran ceasefire has held, but shipping through the Strait of Hormuz is still severely curtailed. That has been enough for some markets to reach new highs, but not enough to make the macro backdrop feel stable. Markets have looked through the initial shock, and while investors have taken comfort that the worst-case scenario has not materialized, energy prices remain elevated. That matters because energy is still one of the fastest ways geopolitical risk can move through the economy. Higher oil prices can pressure consumers, keep inflation expectations firm, and limit how much flexibility central banks have if growth begins to slow. At the same time, the economic data has been broadly supportive. Manufacturing has improved, the labor market has remained resilient, and corporate earnings have helped to justify a market that continues to climb. Our view is that three themes will continue to shape market outcomes this year. First, geopolitical regime change is shaping the investment backdrop. 2026 has brought that into sharper focus. The US-led world order that took hold after the Cold War is gradually giving way to a return of great power politics with more economic nationalism, strategic industrial policy, onshoring, and the growing use of trade, technology, and finance as tools of state power. The chart here highlights how geopolitical risk can quickly shift market expectations. Each bar represents the change in market pricing for year-end central bank policy rates. The increases show that investors are now expecting less monetary policy support this year, which has implications for growth and earnings expectations. Second, we believe artificial intelligence remains a concentrated market driver. From the start of the year, we've had a high conviction that AI would remain a positive force for markets even after the big tech sell-off in Q1. Hyperscalers still have strong earnings and cash flow. Halfway through Q1 earnings season, large cap tech is driving more than 85% of total earnings growth. And these companies continue to recycle cash from their core businesses into AI investment. The chart here shows that dynamic in action. Computer and tech investment is still growing at a strong pace, while spending across the rest of the economy has been flat to negative. Under the surface, though, investors are differentiating between platform owners, enablers, and downstream applications. Quality remains our preferred lens, especially profitability. That matters even more when market gains are this concentrated. Third, we think the US policy mix remains an important support through the rest of the year. On the Fed, we still expect 1 to 2 rate cuts this year. That is now a dovish view given where consensus pricing has moved, but we keep open the possibility that the energy shock weighs on growth and allows for monetary easing. On the fiscal side, we also expect pro-growth policies to help sustain US economic activity. As this chart shows, the tax cuts in the One Big Beautiful Bill Act are expected to provide a meaningful boost to consumers and businesses. And on the corporate side, the bill includes incentives such as full depreciation for capital expenditures and immediate expensing for research and development, which can pull investments forward. That gives the US a margin of policy comfort that many other countries do not have. In contrast, the European Central Bank and Bank of Japan are considering rate hikes next month, and emerging market central banks are also operating under a wider range of constraints, including higher energy prices and a stronger US dollar. In our view, market performance from here hinges on the timeline and degree of Strait of Hormuz normalization. Despite the ceasefire, commercial vessel traffic remains a small fraction of pre-conflict levels. A sustained pickup in throughput would do more than any policy lever to reduce the inflation tail risk for the second half of this year, weakening the case for stickier prices, a more hawkish Fed, and downside in non-US markets. If the blockade continues, however, energy-driven inflation, a Fed on hold deeper into the second half, and persistent pressure on European and Asian growth become the likely path. When it comes to portfolio strategy, this is less a moment to de-risk and more a moment to be selective. The drivers of this rally are powerful but narrow. AI CapEx is still supporting earnings and investment spending, while geopolitical risk is pushing companies and governments to spend more on energy security, supply chain resilience, and critical infrastructure. That argues for staying invested, but with a bias towards quality, durable cash flows, and exposures tied to real investment themes. For more on this and other global markets topics, you can download our full macro pulse report.